Hey everyone, this is Kirk here again at OptionAlpha.com, where we show you guys how to make smarter trades. And tonight we're going to go over all of the trades that we made for September 30th. So had a couple new opening orders today, and then a couple adjustments to US Steel and EWZ that we made today. So I'll go over the new opening trades, and then we'll talk about the adjustments. As always, if you guys have any comments or questions, just go ahead and add them right in the comment section below this video. I'll make sure I get back to all of those personally. So the first trade that we made today was in eBay, or the first one that we're going to go over was in eBay. So I really like this trade in eBay because today eBay, if you did not hear, or maybe if you did hear, but they announced that they're going to spin off PayPal, which they originally acquired a couple of years ago. They're now going to spin it back off into its own separate entity. And so eBay kind of rallied on that news because they might get some good money out of the sale and IPO of PayPal and their PayPal unit. So eBay did jump on the day, and let's just go to the chart here so you can see. But eBay did jump up to around 56.5 on today's move, and so really nothing anyone could have predicted. This is kind of one of those unpredictable events. But in this case, since we didn't already have a position in eBay, thankfully, we now are able to then go back in there and sell an iron condor. Because implied volatility is still high, I want to do this ahead of earnings, trying to get a little bit of decay into earnings because we've already had this kind of big event happen. So maybe the market's not really looking towards earning as the big event, since a lot of activity is already kind of surrounding eBay right now, and especially with a huge jump in the stock price of almost $4 in a day. So what we ended up doing is we ended up going with an iron condor. We sold the 58.59 call spread above the market and the 55.54 put spread below the market. Now each of these width of these strikes is $1, so our max risk is $1 less our credit. So in this case we took in a credit of almost 60 cents, so that means our max risk is about 41 cents on each of these condors that we sold. So we took in a credit that is well more than our max risk on these trades, which is why I like it, because the credit was really good for these iron condors, had good range, and we were able to sell options that were far away from the market. So our strike's up at 58 for the short strike on the call side, plus our credit puts our break even about 58.60 on the top side. So even though my mouse is just a little squiggly there, it's about kind of in that range. And on the bottom side, our first short strike is 55, and then with the 60-cent credit, it puts our break even down around 54.40 or so. So a very wide range here for eBay as we head into October. So these are not November options, they're October options. So they will expire much sooner, and therefore their time decay is going to be much faster. If we go actually to the analyzed or to the trade tab, you can see exactly where we place these trades. Right at the 30% probability level is right exactly where we placed them on either side today. They've kind of risen on both sides because volatility expanded just a little bit, but that's where I place those short strikes. So again, with these iron condors, when you're placing these trades, people always ask me, they go, where do you place these strikes? And the same thing with strangles and straddles and iron condors. You place them, you place that short strike at the probability level that you're comfortable taking. So if you are more conservative than what we were doing, and if you want to take in less credit but be more conservative, have a higher probability of success, you would then move out on either end. So on the call side, you'd move out to maybe the 59.60. On the put side, you maybe move down to maybe the 54.53. Okay, so you'd move out and further on either end, giving yourself a bigger window of opportunity, but also taking in less credit and getting compensated less for that move. All right, so a couple credit spreads that we got into today. Obviously, we're taking advantage of what the market's given us with volatility. Trying to be a little bit selective. We've been trying to get into XLE for a couple days now and actually got a nice little fill in these. Notice that all of these credit spreads are November. So in this case, we're actually going out just a little bit further because the premium and the pricing was much better for November across the board for most of these than it was for October. eBay was the one that kind of, different one because we're basically playing the recent move that it had based off of this news announcement for the stock. So not as much playing earnings. We don't want to be in that earnings cycle. So we were targeting those October options because they weren't in the earnings cycle for eBay. With XLE, basically what we're doing is playing the bullish side of XLE. Same thing with USO. So you'll notice that XLE and USO are very similar, both in the energy and oil sector. For XLE, we sold the 86.84 put spread, took in 30 cents, so that's well below the market for where XLE is trading. I'll go to the chart here so you guys can see that. But here's a chart of XLE. Our first strike at 86 is down here. So well below the market, definitely giving ourselves a lot of room between ourselves and the market, almost $4 of kind of wiggle room, if you will. We can be completely wrong about $4 and still be profitable in this trade. And what made this really good was that implied volatility is very high on XLE, about the 80th percentile. When we go back to USO, it's a little bit closer with USO, but still high probability trade. It's lower price. So you notice with XLE, it's a higher price security up in the 80s. With USO, it's just a lower price stock at 34.32. So we went ahead and sold the 34.32 put spread, took in a 34-cent credit, so a little bit better than XLE, even though they're both $2 wide strikes. So you notice the difference in the strikes is about $2. With USO, it was a little bit closer, and it did kind of fall towards the end of the day right against our position. But that's okay. We're still in this trade. It still has high probability of success. We have about a 75% IV rank on USO, so very aggressive. But our strike is right here at about 34. So we're kind of right on the doorstep now. We're being a little bit more aggressive in this position. And you notice that we took in a little bit more credit to do that. All right, so the other trade that we made today, just trying to keep it balanced, is IWM. So we noticed that we had a lot of credit put spreads that we were entering into the portfolio, which made us obviously very bearish. And what we want to do is kind of counteract that and make things a little bit more balanced by adding an IWM call spread. So we were very successful doing that last month with IWM call spreads, turned it into an iron condor that expired and did very well, made some good money on IWM. And so we're trying to replicate that again by doing almost the exact same strikes, the 115, 117 call spread in IWM, and took in about a 50-cent credit. So very rich premium on IWM right now. If we go to the chart here, 115 and taking in about a 50-cent credit puts our break even about 115 and a half, which is right there on the chart. So you'll notice that we've got quite a bit of distance between ourselves and the market for the market to rally back up against our position and lose money at expiration. The whole idea here between getting some call spreads and some put spreads is to kind of even out and balance the portfolio, right? We don't want to be too tilted in one direction or another. We want to have positions on both sides of the market. And obviously, if the market just kind of noodles around here in the same area and kind of floats sideways, that's going to be great for both. But we just want to have an opportunity at some point to close out one side or the other and kind of play this market and the cyclicality that we know is going to happen. But it's pretty interesting today that IWM rallied towards the middle part of the day and then just completely fell apart. I mean, I think that kind of the game plan here with a lot of these stocks is that they're really having a tough time finding some ground, but there is some buying power in there. So they're definitely not giving up yet, but they definitely are not having those easy pops higher that we saw just a couple weeks ago and a month ago, where stocks would just kind of float higher on very light volume. There's been a lot more volume here recently, a lot of selling activity, rebalancing of portfolios as we get closer to the end of the year. So it's obviously going to be an interesting time. And October usually is anyway. So no surprise there. All right, so the other positions that we adjusted today is X and EWZ. So very similar. X was a very simple adjustment, one that I'm not going to cover too much because we've made these kind of repetitive adjustments in X, but it's the same logic that continues to hold true, is that we don't adjust the call side or the side that the market's moving against with X, but X had another move and leg down lower today. So what we did is via a vertical call spread, went ahead and rolled down our 41 strike calls to 39 for even more credit. So we sold the 39 strikes, we bought the 41 strikes, but we're already short those 41 strikes, so we were able to buy them back. And the difference between buying and selling was taking in an additional credit of 90 cents. Now remember, at the end of the day, we're still profitable on these 41 calls, and we just don't really report that yet until we've done all of the adjustments in this trade and we're out of it. But at this point, we've banked a profit on the 41 calls, and we're just kind of holding that in our piggy bank, and we're just adding to that with this 90 credit that we took on the 39 strikes on the way down. Now the same thing is with EWZ. Went ahead and, as I mentioned last time in the video, because we added that other call side to the trade at EWZ yesterday, we didn't have a chance to actually see the order get executed to get out of our 50-51 call spread. So we had originally sold this, I think, somewhere in the mid-20s as far as premium or credit, originally when EWZ was much higher than it is right now. And we added a position yesterday on the call side and then took this position off on the call side today. It was the exact same number of strikes, the exact same width of the strikes. And the reason that we did that is because we wanted to just minimize that margin exposure. We wanted to add a position and take one off that's very, very similar, just different strikes. And what that does is that doesn't add any additional margin requirement to our trade and effectively gives us more credit because of yesterday's trade without adding any more risk. So it's a great strategy. It's one that we have done a couple times in EWZ, and we've done numerous times in Yahoo and Google and Apple, and have been very successful doing it. And we're going to continue to do this with EWZ as it heads lower if it does. We'll just continue to move down the call side and keep adjusting with the market as it heads lower. But I think that at some point this thing's going to rally back up. We've got plenty of time between now and October expiration, so it's only a matter of time before the markets become more cyclical, and hopefully we can look back on this video and say, that's exactly what we thought was going to happen, and we see a nice little rally back up in EWZ and X and some of the other things that we're obviously taking a little bit of a paper loss on right now before the end of the month. So as always, hope you guys really enjoy these videos. If you have any comments or questions, just add them right below the video. And hey, if you're watching this video on YouTube or somewhere else out there online, you just have to understand that you're getting this video about 15 days after these alerts and this video is sent out to just our members. So you're actually kind of behind the 8 ball. You're watching these trades. Some of these things have already come and gone. We've already in and out of some of these trades. So if you want to get these trades and this video every single night, you got to sign up at optionalpha.com. And as always, happy trading.